Most founders are still playing 2021 playbook. They think you have to be in San Francisco to be serious. Here's the raw truth. San Francisco is currently a massive charity ward for venture capitalists. You're basically paying a 40% ego tax just to have the California zip code. Please tell me why you would do this. You're competing for engineers with OpenAI and Apple who could easily outbid you by £200. There's a specific type of hell reserved for founders who just hit 5 million in revenue. You have more money than you've ever had, but you're actually less free. You're sitting on the paper fortune. Your burn rate is climbing. And you're still investing in your personal capital like a 22-year-old with a Vanguard account. It just doesn't make sense. Today, I'm breaking down the $100 million portfolio strategy. But I'm not talking about private jets. I'm not talking about asset allocation for operators. I'm going to show you why the ultra wealthy are not buying index fund. That's boring. And the one invisible asset that matters more than your entire stock portfolio combined. Make sure you watch this video to the end, because at the end, I'm going to give you a real life testimonial of someone who's absolutely killing it. He's raking it, making so much money. Most people think wealth is built in the S&P 500. I just don't understand why. It's not. If you look at family offices managing around £100 million, they aren't looking for the 8% returns. They're looking for asymmetric upside. They allocate 30% to 40% into private markets. Why is this, you may ask? Because the public markets are efficient. There's no edge in buying Apple. The edge is in the closed room, private equity, venture, and direct secondaries. But here's the mistakes most founders make. They think private markets means buying a stranger startup. It doesn't. For a founder, your best investment is information arbitrage. The ability to know a market shift is coming 6 months before the amount of money on Wall Street does. Now let's talk about the UK reality in 2026. You're being hunted. HMRC doesn't want you to build a £100 million portfolio. They want to tax your exit into oblivion. The ultra wealthy strategy in London isn't about making more. It's about structural efficiency. It's like using things like family investment capitals, FICs, and offshore management to ensure that when you hit that 20 million exit, you actually keep 18 million instead of 10 million. If you aren't thinking about this at the 3 million revenue mark, you're already losing millions in future tax. You're working for the treasury, not for your family, which you shouldn't be doing because the UK tax everything. Think of it. If you have a property and you end up going into care, the UK would literally sell your property to pay for care, which then goes into the government. It just doesn't make any sense. But here's $100 million secret that nobody tells you. The most valuable asset in a billionaire's portfolio isn't their real estate, it's their access. When you're at the top, you aren't making decisions based on news. You're making decisions based on what 5 other guys at your level told you over a dinner. You're trading war stories that never hit LinkedIn. The biggest risk to your wealth right now isn't a market crash, it's isolation. Making 8-figure decision in a vacuum is a recipe for a 7-figure mistake. The ultra wealthy pay for rooms where there are dumbest people there. Are you? This is why we built Wellington. We aren't a finance channel. We're a private ecosystem for the founders who are currently scaling between 1 to 10 million pounds. We provide the one thing a broker account can't: the peer board of directors. We help you manage the mental overhead of growth so you can actually reach that £1 million portfolio. I just held a dinner not too long ago with so many successful founders, and a lot of them are just reinvesting their money into their companies. They don't hold the S&P 500. Some of them all hold individual stocks. But my main thing for this video is to let you know the SP500 isn't the one, in my humble opinion. It just isn't. Especially when you're a founder, when your risk tolerance is so high. I'm not saying burn all your money to oblivion, no. Let's say 40% of your portfolio is SP500, that's okay. But 60% should be in private market, individual stock, angel investments. This is what people in Wellington are doing. And trust me, these are very, very, very successful founders in London. If you're trying to be part of this community, make sure you click the link in the description. This is a very short video, but any video YouTube recommends right now, I would advise you to click.